Good morning. You are watching live daily market outlook for Friday, 30th of March 2012. The last day of the month shows the US dollar coming under heavier pressure, with the major currencies against dollar hitting their fresh highs and breaking above some important levels, as sterling this morning broke above 160 barrier. Heading towards breaking above the nearly 2 months range, and heading towards next barriers at 161 zone, while the yen is further strengthening and threatening to increase to extend the recent correction of its recent high at 84.17, as some important supports at just below 82 zone are coming under increased pressure. Dollar continues to travel travel south against the Swiss franc, attacking past 2-3 days low at 90.15, which will signal an extension of the short-term downtrend. The dollar index this morning hits its fresh 1-month low at 78.27, while gold is extending its near-term recovery of recent low at 16.45, seen basically yesterday's low at 16.45, regaining important resistance zone at 16.65. Oil remain under pressure after yesterday's fresh weakness and dip to levels just above $102 per barrel. This that might signal as the break of the below recent range floor at $104.30 per barrel. My signal establishing a fresh downtrend of the crude oil. One of the main reasons of the current dollar's weakness was the quarter end in US, as the GDP that grew solidly in the final 3 months of 2011. Momentum appears to have slowed this quarter, with signs of cooling in the manufacturing and business spending, and a pause in the housing market recovery. The Fed's chairman Bernanke said this week, basically on Monday, that growth need to accelerate to bring unemployment rate down further, while he offered no sign the U.S. Central Bank would launch a third round of bond purchases to boost to fasten the growth. The growth is seen slowing to around 2% in the first quarter, as the impetus from restocking by businesses fades. The rising gasoline price, which were the tax on the consumer, were presenting a wild card. So far, there is little signs consumer have cut back, with auto sales surging in both January and February. The gains in incomes should provide a cushion against the pain at the pump. Spending, which accounts for about 70% of U.S. economic activity, that grew at 2.1% pace in the fourth quarter, up from 1.7% in the prior 3 months. Consumer spending data for February, due for release today, could offer fresh clues on the health of the consumer. Spending was flat in January for the third straight month when adjusted for inflation. The build-up in business inventories accounted for the bulk of the rise in fourth quarter output, although slightly less than previously believed. From today's events, the Eurozone's finance minister meeting is one of the top events, and it's likely to agree to temporarily almost double their financial backstops as one of the final moves to end the sovereign debt crisis, although Germany continues to favor a smaller increase. Today, the 17 countries sharing the euro have already agreed to adopt balanced budget rules in an effort to convince markets that Eurozone public finances would be sustainable. They also agreed to slap fines on countries that run excessive budget deficits or have large imbalances in their economies. After a deal with investors this month to restructure the Greek debt increasing the amount of money that the Eurozone can use to help its members cut off from markets is one of the last things policymakers can do to boost investors' confidence. A draft statement by the minister showed by the draft statement by the ministers showed that in case of emergency over the next 15 months the Eurozone could raise the combined firepower of its two bailout funds to 940 billion euros from current amount of 500 billion euros. But this could happen only if during that time there was a need for a new bailout for a Eurozone country, and the new permanent bailout fund called the European Stability Mechanism (ESM) would run out of money to finance it. ESM, which is to go online in July, will have 500 billion euros of lending capacity, and the temporary European Financial Stability Facility has 440 billion euros, of which 200 billion is already earmarked for financing Greece, Ireland and Portugal. According to the draft statement, the ministers are to agree to allow the EFSF to service its existing commitments on top of the full 500 billion euros of new money that would be provided by ESM. The combined lending power of both funds is now capped at 500 billion euros, and any potential new bailouts after July would be handled by ESM. If it does not have enough money, the remaining 240 billion euros of yet uncommitted EFSF money could be used. However, some dissonant tones, again coming, as mentioned earlier, from Germany, as Wolfgang Schäuble, the finance minister of Germany, where public opinion is strongly against more money for bailouts, said that 800 billion euros in the Eurozone rescue aid should be enough. He said that we have 500 billion euros in fresh money available, together with the programs already agreed for Ireland, Portugal and the new program for Greece. It is about 800 billion euros, and according to his statement, this is more than enough. We will see today's gathering of the Eurozone ministers in Copenhagen. What actually the release of after the meeting will give us some more clues and confirm basically what was previously agreed. Again, quite a busy calendar today, as the last day of the week with a number of events from the Far East already been released. So the manufacturing PMI from Japan came a bit higher than the previous release at 50.5. Release today's reading is 51.1. Japanese household spending grew to 2.3% compared to the minus 2.3% of the previous month, and the minus 0.3% forecast for today. The CPI from national CPI of Japan was up by 0.1% versus the forecast of minus 0.1%, which was the previous reading, while Tokyo's core CPI on yearly basis came along with the expectations and the previous release at minus 0.3%. Japanese unemployment rate slightly dropped, as today's release showed a 4.5 of unemployment compared to a previous month of 4.6, and the same figure that was today's forecast. Preliminary industrial production from Japan decreased significantly, as previous month release was 1.9%, and the growth of 1.3% was forecast for today. However, the release came in the negative figure, minus 1.2%. The housing starts in Japan shows the healthy growth, as today's release of the yearly figure shows a 7.5% increase compared to the negative minus 1.1 of the previous one, and the minus 1.4 of today's forecast. Also negative figures coming from Germany, as monthly retail sales dropped by 1.1% compared to the forecast of increase by 1.3%. That was today's consensus, and the negative release of the previous month of minus 1.2%. So compared to the previous release, there is slight improvement. However, the far below the forecast for today. Still to come, Swiss economic barometer that is due at that was already released. Pardon, the Swiss COF economic barometer that came a couple of minutes earlier shows the increase by 0.08 compared to 0.06 forecast, and the negative reading of the previous release at minus 0.11. So improvement is showed on today's release. Still to come at 9 o'clock GMT, the Eurozone's CPI flash estimate. Inflation is expected at 2.5% versus 2.7% of the previous release. The Americas start with Canadian GDP that is forecasted to grow by 0.1% on a monthly basis compared to a build of 0.4% of the previous month. From US batch of data coming, core PCI price index 0.1% is today's consensus versus 0.2% previous release. US personal spending monthly release is expected to grow by 0.6%. As forecast shows the healthy growth compared to the previous release of 0.2%. Also, the personal income is expected to grow by 0.4% versus 0.3% of the previous month release. These indicators are due at 12:30 GMT, while Chicago PMI is due at 13:45, and slight decrease is forecasted today. 63.2 is the consensus versus 64.0 the previous release. 10 minutes later at 13:55 is revised University of Michigan consumer sentiment that according to today's expectation should go up to 74.9 compared to 74.3 of the previous release. That was all from today's events. We're going to take a look now in the markets and see the latest movements of currencies and commodities during the Asian session and the early European session. As shown on the hourly chart, the euro has regained strength after a reversal of previous high at 133.84, extended the weakness down to 132.52. This was the low of yesterday, where the main bull trend line drawn of 130.00 low contained so far the dips, and the fresh strength accelerated actually gains on a break above 133 zone, extending so far to 133.75, just ahead of our upside target at 133.84, as the previous lower high at 133.72 has now been tripped. The hourly studies remain positive and supportive for this, pointing higher. However, approaching the overbought zone, this might signal some corrective action before the bulls come back fully in power, and possible break above 133.84. That will open a way for further extension higher towards our key upside barrier at 134.85, double top of end of February. The structure on the daily side, on the daily chart, remains positive. Studies are all pointing higher, with the firm break above the main bear trend line drawn of 142.46, high of 27th of October 2011, holding firmly for now, attacking the barrier at 133.84 to open way for further extension of the latest up leg from 130.00 low of 15th of March 2012. A weekly closure above this level at which is at 130.00, the bear trend line, broken bear trend line, would confirm the positive structure and signal further strength. That might be seen also today as the all parameters now are supportive for euro for final trust through the 133.84 to resume the current recovery. On the downside, immediate support is at 133.40 zone ahead of dynamic supports 133.27 and 17, 20 and 55 days moving averages, and the 133.00 as said the broken bear trend line, while bull trend line currently stands at 132.73, and only break of this level along with yesterday's low at 132.52 would weaken the near-term structure. Sterling is extending its strong uptrend from yesterday's higher low at 158.59 as initial attempt higher stalled exactly at 160, and subsequent pullback lost some important supports at 159.20, 159.00 that triggered fresh weakness down to 158.41 where the temporary support was found. Bounce higher was capped yesterday at 159.33, and subsequent pullback found support at slightly above the previous low at 158.59, where the fresh strength emerged. Break above previous high at 159.33 accelerated gains as this morning's lift above 159.60 as 70 initial barriers accelerated again through our main barrier at 160.00 with 160.32 seen so far. The studies are positive but quite extended with the hourly RSI already in the overbought territory, yet not signaling no clear signal of reversal. However, we might see some corrective action before the bulls continue higher. We need to see weekly closing today above 160 to confirm the positive structure. That will open way for a firm break above the past 2 months range that was limited on the upside by 160 and the downside by 156, as well as pairs break above 200 days moving average that was capping the upside for a quite long period of time, and the recent two false breaks were seen ahead of a current one that holds for past nearly 1 week, holding above this level, that with the break, firm break above 160.00 to confirm this positive structure. Next targets, static barriers at 160.00, 161, and more significant is 161.64 high of 31st of October 2011, where is also 61.8% Fibonacci retracement of the broader downtrend from 2011 peak at 167.45. That bottomed at 152.33, which is the low of 2012, posted on 8th of January. The dollar yen is under pressure after initial recovery attempt of 81.96 low of 23rd of March failed to sustain gains above 83.00. That was the initial resistance, with 83.38 seen ahead of easing. There were some attempts 2 days ago at above 83 when the price action hit 83.16 and returned lower. Currently the market is testing a key support and the break point at 81.95, 85, with brief breaks seen already down to 81.82. We need to see the clear break to confirm. However, the studies are in the negative territory, both hourly and 4 hour, as current bounce is seen on the hourly studies hitting the oversold territory. Immediate resistance on hourly is 82.23, which is the 20 days exponential moving average that so far holds the upside ahead of 82.50 overnight's high, where is also the 55 days exponential moving average. to improve the current negative structure, actually to ease the immediate bear pressure, we need to see the gain of a previous strong support at 82.60 zone and break above 83.00 in order to avert immediate downside risk. Lift above 83.38 is to sideline the near-term bears and open way towards the higher levels. So far, the negative studies keep the downside favored with the firm break below 81.95, 85 break point to confirm the stronger correction of the 2 months uptrend from 76 to 84.17 as daily studies are firmly pointing lower, and loss of bullish momentum supports further weakness with the next significant target at 81.05 that marks 38.2% Fibonacci retracement of 76.00 to 84.17 rally. Below this, there is another static support, higher platform at 80.55, beginning of March lows that will come on a break lower. For now, the studies, as said, are firmly negative and keep the downside vulnerable with firm break below 81.95, 85 break point to open way for a stronger reversal of 76.82, 84.17 rally. The dollar Swiss also under heavy pressure as 90.15 now has been lost, 90.07 since so far. This level kept in past couple of days the downside protected, but recovery attempt despite the brief break above our initial previous strong support. Now resistance at 90.70 failed to sustain gains. The highest level was seen at 90.91 yesterday, where 55 days exponential moving average capped the upside action and subsequent weakness, and now breaking below 90.15 near-term consolidation floor, below which that price already broke is 90.00, the only obstacle on the way towards 89.30, our next downside target, and strong support, double bottom of 24th and 29th of February 2012 to open a way for a further extension of the short-term weakness of 95, 93 beginning of 2012 high, as the pair so far retraced over 61, actually exactly over 61, pardon, percent, 61.8% at 89.30, 89.58 is the 61. So that would be below 90.00. That would be our next target ahead of the main one at 89.30. Break below this level opens the next significant one at 88.47, which is 200 days moving average. Studies on the daily chart are negative, holding below their midlines, and the current break below this short-term trend line is to confirm the negative structure as the part of a broader downtrend from 95 and 93. The yellow metal has benefited briefly in past 2 days on the overall weakness of the dollar, as it dipped so far to 16.45 on the recent reversal from 16.97 seen on 27th of March. The price's near-term action above initial barrier at 16.63.65 zone is required to 16.66 insofar is required to spark some stronger recovery with the brief break above 55 days moving average on the hourly chart seen supportive for further extension higher. Next significant static barriers are at 16.73 and 16.84 ahead of 16.97. On the larger picture, the studies are still in negative, and we have a double moving average at this zone that needs to be cleared in order to signal stronger recovery as a part of the broader corrective action from a 16.28 low of 22nd of March 2012. However, regain of 1700 zone, which is our main upside target, needs to be seen in order to improve the current structure, as the studies on the 4-hour chart are still pointing lower. Situation on daily is firmly bearish, as the price failed to hold sustained gains above 200 days moving average. This was the brief break to 1697, followed by subsequent reversal. So break through 1688, which is 200 days moving average, and or previously mentioned the 1700 barrier is required to improve the current negative structure, as it lost traction on approach to 1802. That was our initial upside target when the gains stalled at 1790, and the subsequent sharp decline dipped so far to 1628, which is approximately 61.8% Fibonacci retracement of the broader 1522 to 1790 ascent. The crude oil basically suffered the heaviest losses during the past couple of days, as the recent reversal through the main support, the range floor at 104.30, and break of the main bull trend line drawn of 74.94 low of October 2011, and now signals further weakness ahead. A brief break below 55 days moving average at 103.32 has so far been contained just above 90 days moving average at 101.97, as the crude oil hit lowest yesterday at 102.12. This was the lowest one since lowest price since mid-February, and the break below the range. This was mentioned in our previous sessions. The break of either side, as the oil price was mainly within the range during the whole March. Break of either side would define the next trend. The break on the downside now risks further weakness, as the price also penetrated into the previous range, broke the previous range ceiling that was at 103.72, broke the main trend line. That might risk further weakness, weakening. Daily studies are seen supportive for further extension lower, as the oil price lost the bullish momentum, and now risking further extension lower, with the immediate target at 102.12, yesterday's low, and the 101.77 and 90 days exponential moving average that might signal further extension lower. From the Fibonacci levels, the current reversal touched 23.6 retracement of the broader down up move from 23.6 of the broader up move from 74.94. We need to see the clear break here to confirm a reversal and open way for further extension. 97 zone is seen next, where is also the 38.2 Fibonacci retracement ahead of 200 days moving average at 95.50. On the near term, hourly studies are firmly bearish, but current bounce is seen on oversold, this is 4 hour. Okay, similar situation, hourly and 4 hour. Bounce on the oversold conditions sees quite strong barrier on the previous range floor at 104.30, where is also 20 days slightly above, of which is 20 days exponential moving average standing at 104.85, and I would say bounces higher should be contained around the 105 zone in order to maintain the current negative structure. That was all from today's market outlook. Have a nice day.